Hello, and welcome to this webinar on the slightly disconcerting topic of investing amid lawlessness. What I want to do today is try and take what looked like a completely random collection of recent news headlines and show that in fact there's a common theme, and that theme has rather specific, albeit long-term, implications for how you invest. The title here is quite deliberate. For me, this isn't just about Trump. It isn't about geopolitical noise. It isn't even about Iran specifically, even though all of those things are, of course, dominating the near-term, day-to-day market moves. I think we're seeing a structural shift that's going to keep affecting your portfolios for years to come. And I want to try and explain not just what's happening, but why it's happening, because I think understanding the why is actually what changes the investment conclusions. So I've collected these headlines. I could have collected hundreds more. Maybe I should have added the third attempted assassination of President Trump. The point is that they may look completely disparate: courts blocking Trump, attacks on Iran, AI copyright issues, difficulties constructing new housing, oil bets placed just ahead of the Trump social media posts. Most people look at these and they see a collection of kind of unrelated crises, or at most they say this is just a few political bad actors. For me, though, the common theme is this descent into lawlessness, and the drivers run much deeper. Rules-based systems at every level are being progressively hollowed out. It's not just international, it's domestic, it's corporate, it's technological. I want to show that that's not an accident, not just something associated with Trump and other populists, and then it's not going away. And that's kind of a big claim, maybe especially at the moment, given we just had the Hungarian election results with US courts pushing back on Trump in several areas. I'm going to spend the rest of the presentation trying to back it up. I'm also conscious that the theme itself is quite long-term and hard to invest from, that there's a lot of other stuff going on, and quite a few of you may want to tackle all the other things driving the short-term outlook as well. So hopefully between the slides and the Q&A, I'll manage to do justice to both. As usual, I've divided my presentation into three. First, we'll look at what's happening in markets right now a little bit, and why I think the unpredictability is driven by more than just the fog of war. Then I'll try and spell out the reasons why the underlying drivers of the shift towards lawlessness are not just political but structural. And then finally, we'll look at what it means when it comes to making investments. As usual, I'm going to go really quite quickly through the slides. There's actually a lot of data here, especially in the middle section, but the underlying principles are relatively straightforward, and then we can always revisit things in the Q&A if you want. If there's one thing that I want to achieve in the next 35 minutes or so, though, is to convince you that this lawlessness we all want to treat as temporary noise is actually what in the long term is going to be most important for financial markets and for your investments. Not necessarily next week, but over the next few years. And that while that may look like an impossible paradox between short and long term, actually there are some quite specific implications, even for portfolios as they stand today. I'll leave time for Q&A at the end, but you can type in questions all the way through. Let's just start with where markets are right now. So clearly all the short-term market discussions at present are completely dominated by Iran, by the effective closure of the Strait of Hormuz, by speculation as to how long it's going to remain closed and how much damage that's going to do in terms of stagflationary impact to the global economy. I think there are two important observations to make here. One is that while oil clearly drives everything, it's actually interesting how equities in particular, and then to a lesser extent, credit spreads, have managed to break away from some of the oil price moves, basically rallying over the past week or two, even as oil prices have spiked higher again. I'll have a bit more to say about that later, but maybe we should revisit it in the Q&A. There are some important monetary drivers, which aren't really my focus today, but which actually fit quite neatly into the framework I usually use. The second thing to say is that the near-term twists and turns are obviously completely dominated by the latest Trump tweet, and they're almost completely unpredictable. Yes, perhaps we're gradually come to the conclusion that the strait is going to be closed for longer rather than shorter. Yes, perhaps you may occasionally be able to trade some of the short-term moves by figuring out at some point Trump chickens out. But in general, It's really not obvious that even Trump knows his own mind or has clear objectives. And I think both real money and hedge fund performance kind of affects that. It seems increasingly correlated with the risk moves, but it's also lagging them. And the overall and overwhelming impression I get from talking to people is that everyone just wishes we could go back to normal, away from the politics, go back to fundamentals. And yet, sort of my whole argument today is that even if the conflict ends, even as risk keeps rallying, we can't and shouldn't go back to those fundamentals because there's something deeper going on. So first thing we should look at is just why risk has held up so well. Some of that's a monetary story, credit expansion, especially in the US. Some of it's fundamentals, though. If you look at consensus data, and I've updated this relative to when I published the presentation a few weeks ago, what's remarkable is just how little it's moved. Yes, you are now seeing CPI expectations in particular moving higher, and that makes sense given oil prices and growing worries about fertilizer and food costs and things. But even then, next year's CPI expectations are unchanged. GDP forecasts in the US are still above where they started the year. Globally, they're flat. It's only really in Europe where they're starting to be cut, and one or two people are talking about recession. Even then, most forecasts have only fallen by 25 basis points or so. So, and if anything, when you look at corporate earnings expectations, the pattern is more extreme still. Earnings estimates are still grinding upwards, not only given the AI hyperscaler spending and semiconductor optimism, also more broadly. And again, that's a sort of interesting theme. There was a great piece by Hussman just the other day, research about margin expansion as a driver of it. But I think, first fundamental driver is, well, consensus hasn't shifted all that much. And all that feels a little bit at odds with some of the more obvious risks to the world outlook if oil prices stay higher for longer. Somebody put it nicely to me the other day. They said, all their friends who work in finance are completely mystified to see the S&P making new highs, and all their friends who don't work in finance don't see anything odd going on at all, and they're simply buying as usual. So I think we can give three reasons for starters why the consensus has been so resilient. The first is that even people in markets, even markets themselves, think any oil spike is temporary. You can see that directly in the futures curve. Spot is much higher, but people's forecast for 1 year out has still only just begun creeping higher ever so slightly. And then same thing with respect to inflation break-evens. They're only picking up very modestly at the short end. 5-year and 10-year break-evens have barely moved at all. Now, some degree of backwardation or inversion in oil clearly makes sense. There really are long-term oversupply concerns, which will play a role if there's a proper ceasefire. But at the same time, there's obviously a vulnerability here as the conflict drags on, and both sides still seem to think it's in their interest to back down. Nevertheless, the market thinks it's a short-term effect. Second reason for the resilient consensus is that the economy has actually proved really very good when it comes at shrugging off multiple prior shocks. So whether it's tariffs last year or even COVID before that, we might make excuses in terms of the tariffs were reduced or there was offsetting stimulus with COVID. But one way or another, there's been more flexibility, less tendency to fall into recession in recent years than many people might have expected based on history. And you can see that in things like the economic surprise indices. Obviously, they're designed to mean revert, but even so, the US has shrugged off multiple, what looked at the time like serious hits, all the way back to 2019. And again, you can sort of take this two ways. You can say, at some point, that resilience may break. Maybe we're getting close to it, given this pickup in oil prices and commodities generally, and the fact that inflation break-evens have just begun to move. Maybe investors are simply too sanguine, and maybe for long bonds in particular, we might make that argument later. But the fact remains that time and again, the economy's been shrugging off these shocks, and the only question is whether the underlying reasons for that resilience remain intact or whether they are more fragile than they might appear. And then the third reason, the final reason, is a bit circular, but to my mind, this is almost the most important. The economy has been resilient in part because markets have been resilient. And this has sort of been a big theme for me for years now. Savings rates near historic lows, especially in the US. Wealth effects are close to record highs. People are effectively spending their wealth gains rather than saving. And yet, provided that spending and saving keeps pushing the equity market up, it sort of creates a perpetual motion machine. There's a point where this may break. People are already worried about the K-shaped economy. Sentiment among poorest consumers started deteriorating over a year ago. More recently, it started falling even among the wealthy, and that looks increasingly incongruous as the S&P makes new highs. There could be a vulnerability there, but at the same time, it seems just as likely that that gets resolved by sentiment picking up again as it does by the S&P falling. As long as markets hold up, spending holds up, confidence holds up, earnings hold up, and you get this circle. I've said in previous pieces, it's all a bit of a Ponzi scheme backed by expanding credit and exuberance and people sticking money into the stock market. But the thing about Ponzi schemes is that they're often quite sustainable, provided people keep believing in them. And so the final thing to say about the short term is that, as we've seen over the last couple of weeks, the buy the dip mentality basically seems very much intact. And that creates this paradox of near-term durability, but longer-term vulnerability, which I think is at the heart of the puzzle as to how to position. Some of the hot positions did get flushed out with the Iran attacks. For gold in particular, it's interesting how it's now trading directly with oil, and US inflows to ETFs in particular have fallen. But especially for US equities, and even in general for things like credit, it's kind of amazing how there's just this remarkable willingness to keep piling into risk. There's this sort of odd mix of being oblivious on the one hand, and yet also being justifiably confident or complacent that if we keep pushing equities up, we don't need to worry about the politics. And as I say, there's a monetary driver here in terms of credit expansion, which maybe makes it a bit more durable as well. So for the purpose of today's presentation, though, what seems ironic is that with all the dip buying, for all that it may be temporarily sustainable, it increases valuations. It creates what feels like an ever more obvious mismatch with some of these political developments. Somehow, when it comes to positioning, we need to reconcile those two conflicting currents. And I think here is where it's worth coming back to all of these disparate headlines, only now I've organized them. The market's sort of desperate to wish away the risks from the Iran war, desperate to wish away the risks from Trump threatening Fed independence. Companies are desperate to ignore the risks coming from conflict and tariffs. The AI companies are mostly anxious to downplay the risks of either political interference or of their models one day doing terrible things to humanity. But as I say, if I reorganize all of these risks, they're not just political, they're also structural, they're technological, they're coming from multiple directions at the same time. So it's not just one administration or just one election, it's systemic. And I think the short term is genuinely very hard to predict. I think prolonged conflict is more likely than imminent resolution, but nobody really has a good handle on this, and plenty of people have lost money trying. The medium-term forces, on the other hand, seem to me much more durable than the short-term ones. Yeah, they will oscillate a bit, but they were there before Iran, they'll be there after Iran, and they're coming from several directions at once. So let's look now at why that's the case, why the drivers are structural, and why, even if the Iran conflict goes away and President Trump loses the midterms or is even voted out of office, actually many of the underlying implications for portfolios are likely to remain regardless.